Hi, everyone, and welcome back for another week of the Wealth Cafe. And we are continuing on in our financial planning month series. And so today we are going to talk about the different buckets and retirement. So I love this analogy or this visual that we can use because there are really three main buckets when it comes to talking about your money and your finances in both retirement and also pre-retirement. So something to talk about and consider, the FIRE movement became very popular pre-pandemic and then also into the pandemic as well. And for those who don't know what that is, it stands for Financially Independent Retire Early or Financial Independence Retire Early, whichever iteration you want to use. And the whole concept behind the FIRE movement is that you're saving as much money you can to be able to retire as early as possible. Something, though, that I don't think is talked about enough when it comes to either FIRE or retiring early is that you need to shift a little bit in how you are contributing to your retirement buckets. For example, and also too, before we dive into that, I want to say that there are three different buckets that we are going to be talking about today, right? So the first of which is your tax-free bucket. This is something like a Roth account or insurance proceeds. This is money that you have already paid taxes on. Then number two, you have your taxable retirement bucket. These are things like Social Security, a pension that you have to pay taxes on, traditional 401k or traditional IRA money, things that you haven't paid taxes on yet because you were getting, for example, in with a traditional 401k or IRA, you were getting the tax break and you were having that money grow tax-free. So now you need to pay taxes when you pull it out. The third bucket that we are going to be talking about today is your taxable money. And that is everything that you would use both during, pre-retirement and during retirement. This is money that was probably in a traditional brokerage account or in a bank account or a high yield savings, however you decided to keep this money, and you are paying things like taxes, capital gain, or other different fees on these accounts or taxes because they are not set aside for your retirement savings and they don't have any other benefits like that. But you are able to invest and grow your money and do different things in that case, but you are paying things like capital gains or income tax. So those are the recap of the three buckets that we are going to be talking about. And if you are somebody who, let's say, wants to retire at age 50, you're really going to also have to focus not only on having enough money in retirement, but also having enough money in that taxable bucket because you can necessarily pull from your Roth IRA or your traditional IRA without penalty. Yes, there are some different ways around this, but number one, you want to be giving yourself that time to grow, and you want to make sure that you are really following the rules of what these accounts are intended for. So many people I know will tap into these accounts and say, oh, it's just a loan or it's whatever, I'll pay it later. But it really does stunt the growth of the account. So we want to make sure, and this is what buckets are for, right? These buckets are meant to help you set things up so that way you have the plan for where you're going to draw at what time. And some people question, they're like, why would I use a financial advisor during retirement? Financial advisor, in theory, if you're working with the right one, should be helping you strategize what of these different buckets to be filling up leading into retirement, and then how to properly draw from them during retirement or as big life events occur, like a home purchase, children's education, buying a car, you name it. So when it comes to retiring early, you really need to focus then on adding a lot into your taxable bucket because you can pull from this bucket at any time. Yes, you want to have strategy behind it when it comes to what you're investing in to make sure it lines up with your different time periods. But unlike a retirement account, this is going to allow you to draw, let's say you do decide to retire at 50 or 55. It is before that 59 and a half that we typically see in retirement accounts. And so to avoid those penalties, you're going to have to rely on things like this taxable account. And this is why filling up these three buckets is so important and talking about the strategy behind it. And it's going to vary for every person and what their goals are. If you missed last week's video, we talked all about building a financial plan, and this really feeds in and reiterates why a financial plan is so important. Is you're going to figure out what goals are going to be funding and how much you need in each of those three buckets. That's part of the financial planning process. And so as we are diving into these three buckets, we want to talk about the strategy of, okay, in this situation, where would we be pulling money from? If you have an emergency, where would you be pulling from? And your different accounts feed into these different buckets that we have. So I encourage you, a little bit of homework this week. Go through your different accounts and understand which of the three buckets would they fall into. So just to recap, if you have a Roth IRA, that would fall into that tax-free account that we've covered because you've already paid the taxes on it. So that's your tax-free retirement account. If you have something like a traditional 401k or Social Security funds, that is that taxable account. You're going to pay taxes on it. Yes, you pay taxes on Social Security. I know it's still a crazy concept to everybody who hears it. And number three, what accounts do you have, like a brokerage account or a high yield savings or your checking and debit and savings accounts that feed into your taxable bucket? And if you're unsure of these, feel free to reach out to us and we can set up a consultation and talk about how your buckets are set up. Because you want to understand what accounts feed into each of these three buckets and where these accounts are. That is still part of the process, right? And then you want to know, where would you pull from? If in the event that certain things happened, where would you be pulling from? And as you are working with a financial advisor, whether it's us here at Tanis Financial Group or another advisor, make sure you understand where you have these buckets for. And if you have concerns about certain life events happening, or maybe you want to pay for a child's wedding or grandchild's education, or things that may have come up more recently, make sure you're conveying these to your financial advisor. They want to hear and know so they can help you strategize. I also want to point out that how much you are contributing to each of these buckets may shift over time. Once again, as we talked about last week, your financial plan is going to change as your life changes, and it's meant to. Part of that means the way that you fund these buckets is also going to change. You may have spent a lot of time in your earlier years funding your retirement buckets, and now you're sitting here saying, okay, well, what if we want to do things pre-retirement, like pay for a wedding, buy a second home, and we don't want to tap into those retirement funds? This is where that taxable bucket might come into play if that's the right fit for you. That's also why it's such a great reminder of having these different options and places to pull from. This is a little bit of a deeper level, but where you pull from can also impact your income tax levels. And so that's a little bit more of that 3.0 that we talked about, but it's something that your financial team should be guiding you through, whether it is your accountant, your financial advisor, a banker, insurance person, whoever it might be that is part of your team. Make sure you understand the tax consequences behind all of them. And if you want to pull from these different accounts earlier than life, know what the penalties could be or the taxes, because pulling from certain accounts will also have an impact on your different tax brackets. And it's going to depend for the type of account and also potentially how long you have been holding those investments. If you have a taxable account, which could be your typical brokerage account, and you pull money out and you've made, for example, $100 in interest or dividends, whatever it might be, in the last 6 months, that's considered a short-term gain. So that is going to come in and impact your income rather than your capital gains. So there's so many different moving parts to this, and this is why it is essential to understand on a personal level what you have and how it's working for you. I encourage you, if you have any questions about this, please reach out to us and schedule some time to talk. I know it can be confusing, and we want to make sure that you have your buckets, the buckets you need set up for your lifestyle, and as well, you know where you can be pulling from, and your advisor should be working with you in order to help you figure out, where can you pull from? What if you decide to have additional life events and you want to take the family on vacation? It's what the money is for. So make sure you are working with your financial team, and we will see you next week as we dive into a full financial plan. And I can't wait to show you the ins and outs of it so you can really take a look and understand visually what the financial planning process looks like. I think it's going to be very powerful, and I can't wait to see you next week.
Thanks for watching this week's episode of The Wealth Cafe. Looking to learn more about financial planning and wealth management? Visit tanisfingroup.com to apply for an introductory call today.